Over the years, technicians have devised a number of different ways of physically representing market data on charts. We unfortunately don't have enough time to consider all of them in this session, so I'll be covering the ones that are most widely employed. Let's start off with bar charts. Most charting methods plot the price on the vertical or y-axis and the time on the horizontal or x-axis. This is certainly true of the most common form of charting, namely the bar chart. The portrayal of prices in this case is achieved with vertical bars. Its height represents the trading range for the period in question. The top records the high and the bottom the low. A tick mark to the left represents the opening price and a tick mark to the right the closing or settlement price. The bars also reflect the time period in question. If the data is weekly, the bar will reflect the Monday opening, the Friday close, and the intra-week high and low. In daily charts, the bars reflect the daily trading range, and so forth. Now, the advantage of bar charts is that they visually provide a lot of information. The most important parts are the opening and closing prices. The opening is helpful because it reflects the psychology of market participants as they begin the trading session. Closing prices are valuable because they reflect traders and investors who are willing to take home a position overnight. Of course, this principle does not apply to intraday charts because the session is continuous and therefore no one is forced to sit out with a position when the market is closed. Even so, closing prices still appear to form a useful function for this intra-session price activity. When you study the subject of 1 and 2 bar price patterns, you'll appreciate that the characteristics of a single bar can provide useful clues as to the future course of market action. Underneath most charts, you'll see some more vertical bars. These measure trading activity or volume, and that's for the particular time period in question. Most of the indicators and techniques used in technical analysis represent a statistical variation on the price. So it's extremely useful to monitor volume as it reflects a different variable, one that is totally independent of price. The negative for bar charts is that they can include a lot of intraday random noise. But the positive is that they include the 4 points during the session, the open, the high, the low, and the close, and they therefore reflect the character of the session that they're representing. In the line or close-only style charting, the highs, openings, and lows are ignored. Only the closing prices are considered, so the continuous line joins them. The line chart does not provide us as much visual information as the bar chart, but in many respects it's more useful. First, since the high and the low are ignored, much of the random noise that occurs during the trading session is eliminated. Second, because of the cleaner chart look, it's much easier to visually spot the prevailing trend. This means that reversals are also easier to identify. Third, the closing price is important since it reflects only those participants who are prepared to hold the security overnight or over the weekend. This is not true for intraday securities and those that are traded on a 24-hour basis. However, participants who are left holding the security at the close generally have a greater conviction and are more likely to be in tune with the prevailing psychological trend. Finally, close-only charts can be plotted for longer time spans, since bar charts require a space between the bars, and too many periods will visually clutter up the chart. The candlestick form of charting has gained popularity in the last few years. This method originated in Japan several centuries ago and basically offers the same information as bar charts. But the difference is that candlestick charts can often make it easier to spot certain phenomena not readily apparent with a quick glance at a bar chart. The candles consist of a vertical rectangle with 2 lines spiking up and down. The vertical rectangle is known as the real body, and it encompasses the trading activity between the opening and closing prices. The vertical line above the real body measures the distance between the high of the day and the higher of the opening or closing price. It's known as the upper wick. The lower line represents the distance between the low of the day and the lower of the opening or closing price, and that of course is known as the lower wick. You may be saying to yourself, how do we know whether the upper part of the real body is the open or the close? Days when the close is higher than the open are represented by transparent white real bodies. Days when the opening is higher than the close are displayed by a solid black real body. Even though candles can be plotted for any period in which the information is available, I use days in the example because the daily candle charts are the most common. Here's a daily candle chart of Alcoa, for example. Candle charts place greater emphasis on the opening and closing prices than do bar charts. One advantage of candles is that they take up a lot of horizontal space, so it's possible to plot only a small amount of data at a time. Fortunately, candle trend reversal signals are very short-term in their nature. While they're certainly no magic wand, they are a useful technical tool for short-term traders. For those interested in candles, we have a whole module devoted to them later on, where I'll drill down in much greater detail. Finally, point and figure. The point and figure charting method differs from all others in that the horizontal axis does not measure time, but rather the amount of trading within a given price range. You can see a time scale on this chart, but it's just there for reference purposes, as the dates are plotted irregularly, not equidistant as on a regular chart. The point and figure chart consists of a series of O's and X's known as boxes. The O's reflect declining prices and the X's rising ones. Each box is set for a certain price movement. For example, it's normal in stock market charting to set each box for $1 for stocks trading above $20. Thus, every time the price moves up by $1, a new higher X is drawn on the chart. If it moves up by 99 cents, no new box appears. However, if the price declines by $1, that is $1.99 from the high, then an O is plotted. Since price fluctuations for any given security are largely a function of time, long-term charts are constructed with large boxes and short-term ones with small boxes. The point and figure chart takes a bit of getting used to, but its proponents are adamant that it's a very valuable form of charting. Since it's a very specialized subject, I'll not be covering it in this course. However, if this approach sparks your interest, I encourage you to find out more about it. Prices in bar and line charts are displayed on the vertical or y-axis. There are two key ways in which they can be scaled: arithmetic or ratio, sometimes known as semi-logarithmic. This is an arithmetic scale, which plots each price differential with the same vertical distance. Thus, the vertical distance for a price between $100 and $300 will be the same as one between $900 and $1,100. On the other hand, the ratio chart allocates the same proportionate price swing the same vertical distance. Thus, a doubling of the price will be represented by the same vertical distance, whether it's from 500 to 1,000 or 1,000 to 2,000. And just to prove that this is the same vertical distance, I'll overlay the two arrows. As you can see, they're identical. On shorter-term charts covering a time span of perhaps 2 to 3 months, it really doesn't make much difference which scale form is used. But for longer-term charts, the difference can be, and often is, crucial. Look at this chart for the S&P since 1900. It's been plotted on an arithmetic scale. Remember, there was a crash in 1929 when stocks lost 85% of their value, but you can't see it here. Also, in 2000 to 2002, prices lost 42% of their value, and it shows up as a far bigger decline than 1929. Now here's the same thing plotted on ratio scale. 1929 is back, and the 2000 to 2002 decline is placed in proportion. I'd like to leave you with the idea that if you have a choice, always use the ratio or the semi-logarithmic scale. Also, crowd psychology tends to move in proportions. Prices often double, get cut in half, retrace 33% of the previous advance or decline, and so forth. That means that the proportionate ratio scale is much more amenable to interpretation of such fluctuations than the arithmetic method.